Welcome to Phillip Mastermind. My name is Kim. DeepSeek, a Chinese AI company, has recently sparked significant market discussions due to its groundbreaking performance in AI models, particularly in its large language model, which directly competes with similar models from leading US tech giants like OpenAI and Google. The company has managed to deliver impressive results using lower-tier chips, which has raised concerns about the future demand for high-end chips and the potential disruptions of US tech dominance in AI. These figures shows DeepSeek V3 achieves very high scores in many of the Hugging Face tests, outperforming many rival models. DeepSeek's cost-efficient approach and ability to perform at a fraction of the cost of American counterparts have caught investors' attention. Its use of more affordable, lower-performance chips to power AI models has spurred concerns about the future need for high-end semiconductor use by the US firm, particularly as the demand for AI computing may shift. Despite facing chip restrictions due to ongoing geopolitical tensions, including US sanctions on Chinese technology, DeepSeek's use of 2048 NVIDIA H800 chips, a modified version of the H100 chips, has raised questions. There are concerns about whether this bypass export restriction, especially since the H800 chips have been on the restricted list since 2023, creating uncertainty about DeepSeek's compliance with US sanctions. This development has had a noticeable impact on the market. US chip makers and AI-related companies saw stock price declines as investors worry about the decreased demand for premium chips. If DeepSeek's model continues to gain traction, it could lead to a structural shift in the semiconductor industry where demand for less advanced chips could increase and high-end chips may see reduced demand. For now, market participants are closely monitoring strategic responses from big tech companies, especially those that have heavily invested in AI infrastructure. If DeepSeek's low-cost model continues to disrupt the market, it may force these companies to reconsider their AI strategies, leading to potential long-term consequences for the global semiconductor supply chain and the competitive landscape of the AI sector. On another note, DeepSeek's emergence from China adds a layer of complexity as it intensifies the ongoing US-China rivalry in the AI sector. Now, US lawmakers are proposing to ban DeepSeek from government devices. Meanwhile, Australia has banned DeepSeek on government devices over security concerns. Locally, the Malaysian market saw weak performance in January, primarily due to profit-taking and foreign selling, particularly in AI DC-related stocks, after news of DeepSeek's large language model performance dampened sentiment on CapEx requirement. Our analysis suggests that DeepSeek's innovative disruption could impact Malaysia's offset sector, as many of their clients, whether direct or indirect, are the US tech firms. With DeepSeek's cost-effective AI models and lower CapEx requirement, demand for high-end chips may decrease, affecting revenue from advanced semiconductor services. Local companies linked to AI and tech infrastructure could also see negative impacts on AI server sales. The good news is, instead of causing disruption, the arrival of DeepSeek may potentially drive the demand for data centers in Malaysia. Data center operators can now invest at a lower cost compared to a year ago, potentially leading to increased infrastructure development and growth in the sector. On a separate note, Malaysian market has never been this attractive in quite a while, with foreign shareholding hitting a record low of 19.4% in January. As of 31st January, the KLCI trades at 13.6 times PE, 1.1 standard deviation below its 10-year mean. FBN Emas, which comprises the big, medium, and small cap companies in Malaysia, now trades at 13.5 times PE, 1.2 standard deviation below its 10-year mean, and we deem this as attractive. As global markets grapple with heightened uncertainty, we emphasize the importance of diversification and a focus on quality amid volatility. We believe Malaysia remains a good destination for equity investments supported by Malaysia's strong economic growth in 2024 with around 5% GDP growth and a 5.5% loan growth, which is very impressive. Furthermore, the country's outlook is supported by stable politics, improved domestic liquidity, and rising FDI. Key sectors like data center, AI, and renewable energy benefit from supply chain shifts alongside catalysts like the JB-SG Special Economic Zone. We recommend a balanced strategy combining both growth and income strategies to effectively navigate the market in 2025. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple private managed account services managed by professional fund managers. By leveraging Phillip Capital Malaysia's private managed account services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural private managed account services, we also offer unit trust funds and PGWA that could cater to different investor needs. That's all for today. Stay tuned to our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.